Hello, everyone. My name is David with Bernstein Financial Services. I'm the business manager here. Thank you for joining us today. We are going to be having Mike Bernstein, one of the owners and partners here at Bernstein Financial Services, give a little presentation about how to be financially secure in your 40s and 30s, 40s and 50s. Sorry about that. We did 20s and 30s last week. We're also going to be joined by Anna, who's one of the other partners and owners here today. Before I bring Mike on here, just kind of some housekeeping things as well. Is a chat zone over to your right if you don't have the screen in full screen. You can ask questions, and then Anna will be able to ask those directly to Mike, and he can actually answer those to you. If it's a question that maybe is a little bit more individual in scope, he might email you directly with that answer to that question. But let's bring Mike up to the screen and he can get started.
Hello. Hi. First of all, I got a little hoarse throat. Sorry. It probably sounds worse than it feels, so don't worry about that. Very happy to be here to talk about one of my favorite subjects, and that's the Big Six, which we'll cover. You might want to know the audience is made up of some people from our LinkedIn connections who I have not met yet, or maybe met on LinkedIn, or one of my partners, and of current clients who decided to join. So welcome to all of you, and congratulations on attending this meeting. A couple other housekeeping items. What I'm going to say is not revolutionary. What's revolutionary is me saying it. There's not a lot of accountants and tax people out there that want to take time to talk about the basics of succeeding financially other than tax returns. So we're not going to talk about taxes a lot. We're going to talk about all the other things that are important in your financial life. There are other people that do this sort of thing. You probably heard of Dave Ramsey, Susie Orman, and they have a lot of good things to say. I feel like they make people feel guilty, and they're very strict the way they want to do things. I'm very loose, very motivating. There's no bad things, only good things. If things haven't happened, work so far, let's fix them and move forward correctly. Okay. The audience is very varied. This webinar, I'm doing 3. The first one was for people starting out, 20s and 30s. This one's 40s and 50s. And the next one is going to be 60 above, older who are close to retirement. It's the same information. I just emphasize certain areas more, because if you're retirement, you're maybe not worrying about college planning. Anyways, got it. Okay. So hopefully you get what from you need, and you're of the right age group and financial situation where you can take what you need. Okay, I'm gonna cover 6. David, could you bring up the book first? I wrote a short book. It's about 10 pages per chapter, 6 chapters on the Big Six, and it's just talking about personal planning. So if I'm talking about something and you're not quite getting it all, the book has it. And David's going to send out a digital copy of the book to everybody, so you'll get it. You won't have to go on Amazon and buy it, although it's, I think, $5 or $10. And so, David, could you bring up the Big Six? So these are them: cash flow planning, insurance planning, retirement planning, college planning, estate planning, tax planning. If you pay attention to these along your life path of financial planning, you're going to have a very good chance of success. So we're going to be going over them, not necessarily in that order for this meeting. Okay, thank you, David. We're going to start. I'm going to spend 4 to 5 minutes on each section. We're going to be here for 20, 25 minutes. That's it. I'm going to take questions if you have any, and we'll be done. If you want to get more details, you can always send me an email. You can get the book and read through the book. Okay, we're going to start with retirement planning. Retirement planning is an ongoing item that's done throughout the years. Most people who are young don't start it till they're in their late 20s, 30s, sometimes not till their 40s. It's okay. If you haven't, start now. If you're in your 40s and 50s, this group, and you haven't started with retirement, now's the time to start. Hopefully you have. And I'll give you an example. Let's say you're 35, 40 years old. You haven't done much yet. Start putting away $1,000 or $2,000 a month. You do that for 10 years, $2,000 a month. That's $240,000. There's some earnings on that. It's probably worth at least $300, $350. You leave it in there another 10 years, not put another penny in. You probably have doubled it up 12 years later. So now you could easily have $800,000 just by doing that at retirement. How much do you need for retirement? Well, it depends on your lifestyle, which is part of the cash flow discussion we're going to have. But The key is slow and steady. Don't feel like if I can't put in a big number, I shouldn't put anything. If all you can put in is $500 a month or $300 a month or $100 a month, do it. Don't do zero, and try and put it in an account where you won't access it very easily. The savings account is not a savings account if you use it all the time to spend money on vacations. It's a vacation account. So create accounts that you try not to touch. Sometimes brokerage accounts, 401ks, IRAs are accounts people don't touch as much. So I like that. Okay. Another item is, should I be putting people view their retirement as just 401k or deferred accounts? Stop worrying about whether it's deferred or not deferred. That's a tax issue. Start worrying about getting the money aside. If I want to have $2 million at retirement, and that's 30 years from now, how am I going to get there? I'm going to start with this amount, increase it over time, do some computations, track it, and I'll get there slowly. Okay. Second, yes, if you want to use tax deferred accounts, good, that's fine, but try and balance it. If you end up with $2 or $2.5 million in a tax deferred account, every time you want to use that money, you're going to have to pay tax on it. And it's very frustrating for people to do that. I want to use it and I got to pay tax. So they have an after-tax account, might be a brokerage account or a savings account or CDs or treasury bonds or whatever it is. And then the pre-tax accounts with the 401ks invested or IRAs, things like that. That way you can draw from each one. So I like that. How much will you need at retirement? Again, it depends on your needs, but the easy way to figure this out is, first of all, you have to know kind of what expenses you'll have. Sometimes they're a little bit less at retirement than they are during the last part of your working life. But let's say your need was $8,000 a month. Okay. Well, you might want to pay off a mortgage if you've got a house by then, and you might want to be able to have $10,000 a month in benefits. Maybe Social Security is 3, that leaves 7. So what you do is you need $7,000 a month times 12 divided by 5%. I need about a 1.7 million invested at 5% to give me that $7,000 a month. So there's ways to figure this out. I talk about my book. Think about it. Do a little at a time along the way. Okay, we're going to move on to the next subject, and that is cash flow planning. This is the basis of doing all the other things I'm going to talk about. If you don't have enough cash flow, you can't put into retirement. If you don't have enough, you can't buy insurance. You can't pay for an estate plan. You can't do the things you want to do. So David, could you bring up the instructions for my cash flow planning? There you go. So there is a spreadsheet that can be sent to you. It's in the book, but if you want to get a digital copy, we can send you one. You want to read these instructions first. Now go over, please, the profit and loss, David. Okay, so this is, you're supposed to fill it in with the income you have at the top. So wages and dividends and certain revenues you have, and you try to make them after tax. So it's your net pay, for example. If you're self-employed, subtract the taxes and put it in there, and how much you make each month. And that's your total revenue. Then the expenses, you put in all the expenses. Now, don't fool yourself. That's no good. Don't put your head in the sand. Put the expenses down as they are now. Don't try and put them as you want them to be, because you got to see where you're at. You always put them down monthly. So if I pay property tax twice a year and it's $3,000 each time, $6,000 total, you divide by 12, put $500 a month. Everything is monthly. You say, Mike, but I don't pay the property tax that way. You can just pay $500 into a property tax savings account. Get the idea? If you're going to take vacations of $12,000 a year, $6,000 a year, whatever it is, put down $500 or $1,000, pay it into a vacation account. Then it makes all your expenses monthly. There you go. It makes all your expenses monthly, and you can have a budget that's consistent generally, right? Be sure to include vacations, entertainment, going out to dinner. Try to include everything, and you can use the history of the last couple of months to figure this out. And then you revise it once a year. You try and improve this. Well, if this comes out to be negative, it won't be a surprise to you because you're negative cash flow and you have to dip into debt quite often. Then you got to figure out, can I lower my expenses? Can I raise the revenue by working a second job? Should I move to a different place? You got to fix it so you have a net at the bottom covering all the things we need to invest in, including retirement. Go to the balance sheet, please. Okay. So the balance sheet, this gives tracks your retirement money as it goes along. I know it's part of the retirement talk, but what you do is you fill in the first year your assets and liabilities, the value of your house or the value of your cars or other real estate, or brokerage account, 401ks, other investments, all of it, checking, savings. And at the bottom, you put down all your debt, credit card debt, all of it. Okay. See how your equity position, that equity position might be $100,000. Okay. And when you're young, it could be negative. You could have more debt, student loan, than you have in assets. That's okay. Now I have 3 and 4 and 5 years later, but I suggest for young people, they do it every like 5, 10, 15, 20 years in 5-year increments. As you get older, you do it in shorter increments. And you track that and you try and improve the equity position all the way along till you get to retirement as you're putting money away. Okay, thanks very much for those. Now, if you have enough cash flow, then you can do all these things we want to do. If you don't, you've got to fix it. You got to figure out how to fix it. There's some numbers that we put in one of the retirement planning examples. Okay, next subject, because I want to stay on track. And David, you're going to keep me on track time-wise, right? Okay, C, that was A, B, and C, estate planning. Okay, so this is for people in their 40s, 50s, that area. Do I really need an estate plan? What if I'm single? What if I'm married but don't have children? What if I don't have a big estate? Do I need an estate plan? Estate plan is for 2 main reasons. By the way, I'm not a lawyer, and this is not legal advice. So you get a lawyer to do an estate plan. I don't do estate plans. I know a lot about them. So 2 parts. One is to direct your assets if something goes wrong. You die, you become incapacitated. It directs the assets, who should handle them, who gets them. It also, what it does is avoids probate as well for that one item. And last, it dictates care. So if I was single and I say, what do I need a trust for? Well, who cares if someone has a probate? I won't get a trust. Well, what if you get incapacitated? Who's going to handle your assets and take care of you? Brother, sister? Oh, my mom and dad will handle it. Well, I'm pretty sure if you talk to a lawyer, they have to go through the court system to do it. Whereas if you have a trust, it indicates who you want and what order, so nobody's fighting over what to do. So the trust helps with care for you, for a spouse. If the parents died and their children, it also indicates who should be the trustees for them, who you decided. So again, relatives don't fight over that. You'd rather have you deciding than other people or the court deciding. So that's a good reason to have a trust. Doesn't really help on tax planning unless your estate's worth more than $30 million. So on average, it's just for directing assets to the right place at the right time. And if you've built up some assets, like 3, 4, 5 million, do you want your kids to get them? What if they're only 20 or 18? Do you want them getting it all at once when they turn 18? Well, do a trust. You could spread it out. So there's good planning that can go on with estate. So pretty much everyone should have a trust as soon as you can afford one, even single people, especially married with children, so that you have designated trustees for the children. Okay, we're going to move on to the next item, D, insurance. Usually I have this as item A, because insurance is so important. We all know it's a given that auto, home insurance, rentalers insurance, health insurance are a given. You shouldn't go a day without health insurance if you can manage it. Okay, that's not what I'm going to talk about. I'm going to talk about life insurance mainly. So I get the comment all the time from people that are, let's say they're 40. Well, if I put money away, it'll earn more over time than life insurance paying for that. What they're taking out of the equation is if I die right away. So what's good putting $2,000 a month away? If I die in the second month, what good is that for my people that are going to need the money? A spouse, maybe a spouse and children. So you got to get the amount of life insurance up front and then worry about retirement. And the amount of life insurance depends on how much you earn and the lifestyle of your family. So you want to replace your income. If someone's making $150,000 and you want to replace that income, all you do is assume, let's say 5% earnings, you divide it by 0.05, you get $3 million. $3 million invested at 5%, $150,000 a year. Now you might say, well, isn't it just supposed to pay off your mortgage? No. Don't listen to the insurance company or anybody else. It's supposed to do more than just that. You may not want to pay off the spouse may not want to pay off the mortgage. They might want to just get the investment money. Okay. And what about college and other items for the kids as they're growing up? So you might need more than the 150. Now, if a spouse is one partner staying at home, should there be no insurance for them? No, there should be insurance. It may not be as much as replacement insurance of income. There needs to be insurance to support the spouse that's still working, especially if there's kids in case they need to take time off and things like that. So for example, If one's making 150, the other isn't making any, staying home, then it might be 3 million for one and it might be 500,000 for the other. What type of insurance? Should I get term insurance or permanent insurance? Permanent insurance has a cash value associated with it, and people associate that with an investment. Well, it is, but it's really meant to, so it's level, the premium's level, the premium doesn't change throughout the years. But because there's a cash value, it's more expensive. So you might be paying $300 a month for a $400,000 policy on a permanent, where $300 a month might get you $2 million on a term policy for 15 or 20 years. Get the amount you need first and then worry about the investment. So if I determine I need $3 million of insurance, get the term insurance first. Get the cheaper insurance, get it for 15 or 20 years, then worry about adjusting it later on. Because if you die tomorrow, you can't play games. You got to have the insurance. Okay. And my book talks a little bit more about permanent and term insurance. Disability. You should try to have disability insurance. At 65, you don't really need it anymore because it's usually till age 65. But if you're younger, either you get it through work or you can buy if you're self-employed, you can buy a self-employed disability policy and it replaces your monthly income if you don't die, right? Well, people think about long-term care. Well, long-term care can do it, but it's a little different type of insurance. Disability is to replace work income. Long-term care is for if you lose, it's for later in life. Okay, so disability, everybody should have some sort of disability insurance. Okay, be careful when you get life insurance. It's not AD&D. That's accidental death and dismemberment. Because if it's not an accident, if it's natural causes like a heart attack, it won't cover. Try to stay away from AD&D in general. You can get more as an extra, but don't use that as your main insurance. Okay, let's move on to the next item, which is, let's find it here. All right. Tax planning. It's the second to the last one. And usually I make it the last because I think it's the least important of these big six. So for tax planning, we're gonna go back to insurance just for a moment because I forgot a slide. Could you, David, bring up the insurance slide? So it's real simple. If you're younger, you need more insurance. As your financial equity, the money you have invested for retirement, grows, and you, let's say at age 65, you have $3 million of equity, so you're ready to retire, do you really need the insurance anymore? So some people keep some level of insurance, but it can be a lot less. So where people mess up is at the beginning when they're 20, 30, 40, 50, they don't have the high amount of insurance to replace because they haven't built up the equity yet. But if you've got a lot of equity, you don't need as much insurance or any insurance. Thank you, David. Okay, to the tax planning. I don't really want to talk about deductions and things like that because that you talk to me or your preparer separately about. I want to talk about don't get behind on taxes. File on time. File every year. If you get behind, catch up. Don't worry about it. Some people say, I didn't file that one year, so I couldn't file that year. And I can't file the next year until I file that year. And then no. You cannot file one year, you can still file the next year. Then go back and do the last year. Don't let them pyramid up. That's a bad way to go. I've seen it happen many times. So stay on time, try and pay your taxes. And one more thing, if you get behind in your taxes, it happens. What you do is you try and negotiate easily. If it's under 50,000 in agreement with the IRS, they'll automatically approve it to pay over 60 months or 70 months, a little at a time, and pay the current year current. Don't try and pay off the old and fall behind on the new because it's a cycle that continues on and it doesn't work very well. The other things about taxes, of course, I want you to put into 401ks and Roth IRAs when it's appropriate, and save on taxes. Use all the tax laws to pay the lowest possible tax according to the tax laws. So that's given, and you should be addressing that on a yearly basis. Okay, we're going to go to the last one, and that is college planning. And again, depending on the ages out there, because it was supposed to be, 35 to 55 ages, you might be through or very getting close. If you're in your 50s, the kid's already going to college. It depends. But you're probably not yet. If you have kids, they're probably in grade school or junior high, or sorry, I'm aging myself, middle school or high school, and put away money for college. A lot of people don't save for college. I don't know what they're thinking. They're thinking maybe the child should have to pay for their own like I did, or it's too hard to save for it, or I'll never make it because it's so expensive. Forget about that. When the child is born, or as soon as you can, start putting away $50 or $100 a month. You could put it into a Guardian account in their Social Security number, and I talk about it in the book. You could put it into an education IRA. You could put it in the 529 plan, all those things. I don't care where you put it again. I care that you save it. So if you put in $100 a month and then a year or two from now, you make it 150, another year or two, you make it 200, and you do a separate account for each child, you may not save the 100,000 you need for college, which it might be over or under depending on the college they go to, but you'll save something. You'll be able to pay the first couple of years maybe, and then you have to borrow the rest, or you pay for it while you're making more money, but you have something set aside. Okay. So I suggest college planning starts early, and you do it steady. Okay. Let's see. David, have you had any questions so far that I can answer? Boy, doesn't my voice sound raspy? Anna, you're on mute.
I'm scrolling through, Mike. It looks like most of the questions are require a little more into it, so we'll be email those directly to our participants.
Oh, okay. So I'm looking at some of the questions also. Go ahead, Anna.
Sorry. The question that I just saw in between, should I be doing Roth conversions now?
So the person didn't indicate necessarily what their age was. So Roth conversions are best when your income is a little lower because you're taking it from a taxable account to a non-taxable account. I think if you can muster the extra tax now earlier in life, Roth is a very good investment for the future because Roth has no taxation when you take it out later on. So a regular IRA, I put in $5,000, I get a deduction on my tax return, and then it grows, and later on in life, I take it out, it's all taxable. A Roth, I put in the $5,000, I don't get a tax deduction, so I don't save the $1,500 in tax that I could save that year. But when the Roth grows up, I take it out, none of the earnings are taxable at all. Well, the Roths haven't been around for that long, maybe 10, 15 years. So a lot of people don't have those Roth accounts, but I encourage people to do one of two things. Either split it up, do some Roth and some regular if you can, or all Roth, because I really like the Roth. So that's a good way to go. But some people say, hey, I got to lower my tax liability no matter what. Excuse me. So I want a pre-tax deduction to lower my tax while I'm in the highest earning years. So now remember, with a traditional IRA, the goal is if you're in the, let's say, federal and state together, a 33% bracket, and I put in $9,000 into my 401k, simple plan, or IRA, or SEP, or whatever it is, then I'm going to save $3,000 on that 1/3, right? I'm going to defer it till a later date. And that's nice. And then when I retire, I might only be in the 20% bracket. If I'm only in the 20% bracket, not only did I earn money on the tax deferred earnings over that time, but I also am paying less tax than I saved before, which is called an arbitrage. And so if you can do that, now some people end up in the same bracket when they retire and when they were working, and then they don't get that arbitrage savings also. Anyways, but that goes back to you don't want all your money in a pre-tax account and none in after-tax accounts. Okay.
We have quite a few questions coming in.
All right. Well, how's our timing? 6:24. So let's go for another 5 minutes. We will stay under the 30-minute item I have, the limit, and we'll answer a few more questions.
Okay. What major tax law changes should I prepare for the next 5 to 10 years?
Boy, I wish I had that much influence on the government that I could tell you. I don't think, if you look at the history of tax laws, even though there have been changes to it, I don't think they've been so dramatic. The top end tax rate, has gone. It was in the 40% federal rate and it went down to 37. The state has stayed about the same over the years. Houses were less beneficial because the mortgage balance, you can't deduct as much, over 750,000 of balance. So things have been limited. So you want to look at those rules. But there's not a lot of changes. I think, again, I don't want to concentrate on the tax law. I want to concentrate on your financial wealth and your financial path to success and freedom. And that's the one you want to concentrate on. So that would be a different seminar to go into the details.
Another one, Mike, is what should I prepare for 4 if I expect inheritance. I am late 50s.
Okay, so let's say you have been trying to prepare for retirement a little bit, and you're expecting an inheritance. Well, is the inheritance 100,000? Is it going to be 1 million? Is it going to be 2 million? Is it going to be 3 million? It does matter. I've seen people put their own life on hold investing because they're expecting older people to die and they would get a large sum. Well, I wouldn't count on that. Anything can happen. So I would try and save for yourself. But generally, inheritance is not a taxable event. Let me give you an example. If I get life insurance, let's say my father dies and he made me the beneficiary life insurance, not taxable. Let's say my father died and I was the beneficiary of his trust and he had stocks and bonds. There's a step up in cost basis, no tax when I sell those after he passes. Let's say he leaves me a piece of property, $500,000 piece of property. Let's say there's no loan, just to me, step up in basis, no taxes. So the inheritance laws are very, very nice. And there's no death taxes on the full estate until about 15 million for one person. So very generous, these inheritance laws, and not so generous in other countries, by the way. UK has a very strict one. Anyway, so you want to look at what those are and how that's going to affect your retirement. And the only ones that are taxable generally are if you inherit an annuity or IRAs or pre-tax money that's never been taxed. Then there's other rules and you get taxed on that as you take it out. But integrate that into your plan.
Okay, David, how are we doing with the time?
I think we have time for one or two more questions if there are any.
Yeah. Should I set up an LLC or S Corp for side income or consulting?
It depends how much that side income. It sounds like you're saying it's not a big amount. So it might be 10,000 a year or 20,000 a year. In that case, I wouldn't set up an S Corp. And this isn't legal advice. It's more on the tax side, business side. Because the costs are too much and the management is a little more complicated with an S Corp. So you need to be more in the 80, 70, 80, 90 net profit range to do an S Corp. LLC, the only reason you want to do that is for some limited liability and maybe have a more professional look, but it doesn't save you any taxes. The S Corp, if you make enough, it'll save you taxes. So just because you set up an LLC doesn't mean you saved any taxes. You merely have a legal protection entity for it. So sometimes when I consult, if I'm you and I have a W-2 job and I consult with another company, they may say, we will not pay you unless you're an LLC or an S Corp. Well, then you got to go ahead and create the LLC. The LLC is easier to manage. You don't have to pay yourself wages. It's simple, and you can have some protection. Otherwise, if you don't need the legal protection and you don't have the high income, just do a sole proprietor. If you need a legal name, have you get a DBA or a fictitious business name, doing business as DBA, of Michael Bernstein doing business as, Rentals R Us. And then you can open a sole proprietor bank account, and it's very easy scheduling your personal return, and it doesn't cost a lot. And then you just go ahead and report that. That way it's easy, but you have a business name if you like. It costs about $100, $150, I think, to get a fictitious business name. Next.
Can I retire at 55 with 450K in the pension accounts?
You need to tell me your expenses. So that spreadsheet that we had with the income and the expenses, 450,000. You want it to last a long time. Let's give you 6% earnings on it. That's 27,000 a year. That's $2,250 a month. Let's say you're getting Social Security of 3,000 a month. Let's make it 3,750. Let's say you've done pretty good there. That would be a total of $6,000 a month. You tell me, can you live on $6,000 a month minus the taxes, maybe $5,700, $5,600 a month? Sounds shy to me. So that means you might need to, it depends. Maybe your bills are really low because the house has been paid off and you have very few bills. So you might be able to do it just fine. Everybody's a little different. Other people retire. I have a client who's retiring. He has $22,000 a month in bills to pay. That's how he wants to live. I said, okay, well, you're going to need $30,000 pre-tax per month. Let's make sure we get that. It's okay. You have your goals. You revise them along the way. Okay. Very good. I'll entertain one short question at 6:30. Any left?
The question may be short. The answer may be long. But let's try. I'm getting a divorce. how will that affect me, and how can I prepare tax-wise?
Yeah, that's that's a long answer, and it probably applies to too few people on this meeting. So I would suggest you send an email to our office separately. David will arrange that, and we'll try and help you and answer questions if you like. Okay. So I want to thank everybody for attending. I'm so excited that you're listening. You may know a lot of the things I just said. The question: if you acted on all of them, and can you act on them, and will you act on them? So I wish you luck. By the way, everything I've talked about, I have been part of for myself for my life. So I'm all talking about things I do. Thank you very much. Have a great evening.
Thank you, Mike. And thank you, everyone, for joining us today. Just as Mike mentioned, we will be sending you a copy of that PDF book as well as the spreadsheets. We will be sending them out tomorrow, probably in the morning, just because we want to make sure that not only people that attended this webinar, but the people that registered and couldn't make it also get the information as well. If you do want to rewatch this information or want to send it to anyone, it will be posted on YouTube later today, and you can send that to anyone and they can rewatch as well. So thank you so much, everyone, and have a good night. Thank you.